Ventures. North Coast is a Cleveland-based investment fund investing primarily in early stage B2B software as a service ventures. We have more than 300 member investors and have deployed over 65 million into about 60 startups in the region. In addition, we have a group of corporate partners like Thompson Hine that make up our Innovation Council, with whom we work on a local, regional, and multinational scale. These partners are dedicated to helping promote startup growth and sharing their industry expertise. To provide a medium to do this, North Coast launched a lunch and learn style webinar series where members of our Innovation Council will share their knowledge on a relevant and timely topic. Today, Sean, a partner in the New Ventures group at Thompson Hine, will talk through the various kinds and general terms of startup investments, including preferred stock, convertible note, non-dilutive financing rounds, and more. For those unfamiliar with Thompson Hine, they are a full-service business law firm with approximately 400 lawyers in 8 offices. Sean, as I mentioned, is a partner within the firm's New Ventures practice group, focusing on representing entrepreneurs, emerging companies, angel investors, and venture capital firms. He typically advises company-side clients from formation through funding to exit and has extensive experience in complex venture-style corporate finance matters, mergers and acquisitions, and corporate organization and governance matters. In just a minute, I'll turn it over to Sean, but before I do, a quick note that today's session is being recorded. A link to the recording will be shared later today. We also will be taking questions at the end of the presentation, so feel free to type in any questions you may have into the chat feature, and we'll monitor those throughout the presentation and address those at the end. I will now turn it over to Sean to begin the presentation. Thanks, Sean.
Great, thanks, Alexis. Hi, everyone. I'm sure I've met some of you, others, nice to meet you, and thanks for attending. As Alexis mentioned, I am a partner in our New Ventures group. It used to be called the Early Stage and Emerging Companies Practice Group. It's basically Thompson Hine Startup Group. We work with startup companies, startup investors. That's all we do all day, every day. We have about a 10-person full-time team throughout the state of Ohio and in Chicago and New York City. So, startup and startup financings are what we spend our time on day in and day out. Personally, I joined the group about 5+ years ago after spending about 6 years in the M&A world doing M&A work, and slightly changed my focus from the M&A world to the startup world and haven't looked back since. I spend personally most of my time working on startup financings. So Alexis, North Coast, and I thought this topic, kind of a refresher maybe for many of you, maybe for most of you, on the various kinds of startup financings that we see day in and day out, and some of the terms that go along with those different types of investments would be helpful, again, just as maybe a refresher to many, but also for those of you who maybe are new to the startup world, either as a new founder or as a new angel investor, might be helpful to get some of the basic terms as you start your journey into the startup ecosystem. So with that, I'll get into kind of the main part of the presentation. Startup financings can come in a lot of different flavors. Generally speaking, there's no right or wrong way to do it. It's generally based on the circumstances of the company and the investor group at the time. With that said, we typically see startup financings made in 3 sort of buckets. The first 2 represent the majority of startup financings we see, but I'll also talk about a third that we do see and have seen more and more these days, with maybe not your very early stage companies, but your more mature startups. So the three types we do see, or the three buckets, are going to be your equity round, where investors are purchasing shares of stock of the target company. Generally speaking, it's going to be preferred stock because investors want the rights and preferences that come along with preferred stock. In the rare circumstance, we might see a common stock round where investors are purchasing common stock, the same stock that the founders hold. But generally speaking, it's going to be a preferred stock round where there's a valuation. The second bucket is going to be your convertible securities. So your convertible notes, your safes, your simple agreements for future equity, and those types of securities. And then finally, kind of the last group that we don't see as frequently, but is available, is kind of your more traditional bank debt and or venture debt, which I'll get into a little bit in the presentation. So the first bucket, your kind of preferred, your standard preferred stock round. So these rounds are going to be a price round. You need a valuation. You're sharing, or you're selling shares of your stock in the company for a certain price per share, and you need a pre-money valuation to determine what that price per share is. Each investor will buy a certain number of shares at a certain purchase price, and that purchase will represent an ownership stake in the company. So that's really one of the main gating items to doing a preferred stock round is you need a valuation. And I'll talk about that a little more when I'm talking about convertible securities, but sometimes that's more difficult to do than others. Maybe the company is super early stage and it's just hard to put a number on it. Maybe the company and the investor group who are doing the round have diverging views on what the valuation should be, and that gap is insurmountable, or at least further away than a negotiation will help with. So that's kind of the gating item. You need that pre-money valuation in order to do a preferred stock round. In terms of the documents, this is the startup world. Efficiency and keeping costs low is the name of the game. So over the years, certain groups, certain organizations in the startup world have developed some form documents. The first one will be your National Venture Capital Association, a suite of Series A preferred stock investment agreements. So they created a suite of 5 documents: purchase agreement, an amended and restated certificate of incorporation, and then 3 stockholders agreements, an investors' rights agreement, a right of first refusal and co-sale agreement, and a voting agreement that are used as a group, as a suite of documents for a startup investment round. Typically, they're geared at a Series A round or later, but can be used really for any preferred stock financing round. And again, they're 5 documents long. There could be other ancillaries, or often are other ancillaries that go along with it. The 5 documents, depending on the nature of the round, the terms that have been negotiated by the company and the investor, each document can be 15 to 30 plus pages long. So it's not an insignificant amount of documents and legal paper. But the good thing is that there are forms, they're posted on the National Venture Capital Association's website. So that helps with efficiency. These are the standard forms that can be used and help create some efficiency there. The next set we see, maybe more infrequently these days, but we still do see, and I've seen a lot in the past, are your SeriesSeed.com form documents. Here, again, as the name implies, usually for a seed round. And instead of having a suite of 5 documents, they've boiled it down to 2 documents: a stock investment agreement, which is essentially your purchase agreement, and your stockholders agreements all jammed into one. And then as the second document, an amended and restated certificate of incorporation. So for a seed round, where maybe the size of the round isn't significant, or several $1 million, we might see a SeriesSeed.com round used because of the efficiency there. And then there's various subscription agreements that can be used for, some quick and dirty preferred stock rounds, right? Maybe a friends and family round, maybe just raising a few $100,000. There's no set form here for subscription agreement like that there are with NBCA and the Series C.com forms, but oftentimes in some of these very small rounds, some insider rounds can be done with a short subscription agreement, a short amendment to the certificate of incorporation can be done very quickly with, created in hours, completed the round in days, as opposed to, weeks or even months with some of the other ones. So terms, what do we generally see in a preferred stock round? I'm going to go through a number of them here. This is kind of like the kitchen sink of terms. Some rounds include all of these, some rounds include some of them, some maybe just one or two. But these are the types of terms we generally see in a preferred stock financing round. So first off, a dividend. These come in a couple of different flavors, cumulative and non-cumulative. With your non-cumulative, it's basically a set dividend on each share of preferred stock, but it's only issued if declared by the board. The kind of flip side of that would be your cumulative or accruing dividend. And this acts as almost like an interest rate, typically set as a percentage. So if you have preferred stock with a 6% cumulative dividend, you're basically accruing 6% of interest on your investment each year. Dividends of that nature can also compound yearly. So it can grow quicker than just 6% or 4% or 8% that are represented. We probably see dividends in about half of the preferred stock rounds we see, but again, no right or wrong way to do it, and not in every deal are there dividends or set dividends. The main term that I would say see in 99% of our preferred stock rounds is your liquidation preference, right? Maybe even more, maybe it's 100%. And this is a key feature of a preferred stock financing, and it basically gives the preferred stock some sort of preference if and when the company is sold or has to liquidate or wind down. It gives the preferred stock, again, this preference. And this comes in a couple different flavors too. You have your participating preference and non-participating. We're participating if the company sells or again liquidates, the investors would get both their money back and any accruing dividends, and then get to participate pro rata with the common stock in the remaining proceeds based on their ownership percentage in the company. So for instance, if the preferred stock had put in $1 million, they own 10% of the company, and the company sells for $10 million, $1 million, the amount they invested, would come off the top, and then the preferred stock would get to share pro rata based on their 10% of the remaining 9 million. So would get, the 10% of that 9 million, in addition to the $1 million they took off the top. Non-participating is an either or. So you either get your money back, or you get to share pro rata based on your ownership percentage in the company. Obviously, whatever one is a larger benefit, produces the most proceeds, the preferred stock is the one they're going to take. Generally speaking, the getting your money back, it would be in kind of a downside sale where there's not going to be enough money to go around or make it worth their while to share pro rata. The flip side, where they share pro rata, would be in a situation where there's an upside sale and they would get more money sharing pro rata than just getting their money back. Some other terms: conversion rights. Preferred stock generally can be converted at the option of the holder into common stock. There also can be some mandatory conversion provisions, generally relating to an IPO. So if the company IPOs at a certain share price and with certain proceeds to the company, all preferred stock would be automatically converted into common stock in order to have just one class of stock in the IPO. A lot of preferred stock will also have anti-dilution protection. This generally just comes up in a down round. So, if you've invested your money in a round that had a $10 million valuation, and the next year the company is now doing a down round where they're selling stock at a $5 million valuation, anti-dilution protection would kick in and, generally speaking, not make the prior investors whole, but give them some sort of protection, some sort of compensation for that down round. Voting rights, generally speaking, preferred stock will vote along with the common stock. So, one share, one vote, whether you're common or preferred. There are some exceptions here, protective provisions. A lot of preferred stock financings will have protective provisions. Basically, these are preferred stock vetoes. The company can't take certain actions unless it gets the consent of some threshold of preferred stock. So the company can't do, and I've listed a few of the typical ones we see here. So the company can't take these actions without, say, a majority of the preferred stock signing off. So certain things that just the commons or just the preferred stock gets to vote on separately from the common stock, and you need their consent in order to move forward with. Typically, you'll see, everything on this list is kind of big ticket items, selling the company, doing a new financing round, taking on significant debt, paying a dividend, changing the size of the board. But, we often see protective provisions negotiated in connection with a preferred stock round. Other terms, redemption rights. We don't see these as often as some of the others, but it's basically a right for the preferred stockholders after a certain period of time, typically 5 years, to force the company to buy back their shares of stock. Registration rights are going to be the ability of the preferred stockholders to force the company to register its securities with the SEC. So basically force the company to go public and hold an IPO. Standard right of first refusal and co-sale rights. These generally right to transfers of common stock by the founders. So if a founder wants to transfer or sell some of its shares of stock to some third party, before they can do that, they first have to offer it to generally the company. And if the company passes, then the preferred stockholders on the same terms and at the same price that they were going to transfer it or sell it to the third party. Board rights. Oftentimes we see preferred stockholders as part of an investment round negotiate some sort of board rights. Maybe it's 1 seat on the board, maybe it's 2 seats on the board, depending on the size of the board. In addition to, or in lieu of, you sometimes see observer rights. So additional rights to attend board meetings and in a non-voting capacity. But often you're going to see at least observer rights, if not board rights, granted to preferred stockholders in connection with the preferred stock financing round. Your standard drag along right. This is the ability of the company and a certain threshold of stockholders that approve a sale of the company to kind of drag everybody else along and approve the sale as well. A couple additional terms here, founder equity vesting requirements. Typically, investors who are cutting a big check to a company in connection with any investment round, but definitely a preferred stock investment round where there's a valuation, they don't want the founders or other key executives to leave the company after they've made their investment. They just cut a big check. Oftentimes with startups, investors are investing in the team, are investing in the founders. And if those investors decide to walk out the door 2 weeks after the investors have made their investment, that's not a good thing for the investors. Especially if those founders can walk out the door with a significant chunk of the company in terms of their stock. So generally speaking, we see investors require founders who don't have a vesting schedule to potentially adopt a vesting schedule to their stock in connection with a closing of a preferred stock round. Or if they have an ongoing vesting schedule, they will require or potentially require the extension of that vesting schedule. So say they had an original 4-year vesting schedule and only 1 year is left, they might say, okay, well, tack on another year or tack on another 2 years, just to incentivize that founder to stick around. And again, if that founder does leave, prevent that founder from walking away with a significant chunk of the company in terms of the stock. And then insurance, we often see this negotiated or required by preferred stockholders. Two main types: D&O insurance, your directors and officers insurance. This is going to be almost universally required if the preferred stock have a right to appoint a board member. They want to make sure that their board member is covered by D&O insurance. And then the other one is key person insurance. This is kind of similar in concept to your founder equity vesting requirements, or at least the rationale behind it is that, again, your founders, your key executives are often what investors are basing their investment on. So a key person insurance policy is basically a life insurance policy on that founder or on that key executive. And if something were to happen to that founder or that key executive, the policy would be paid out to the company, which would, blunt the impact of losing that person. A couple other terms we see more often than not in preferred stock rounds: your information rights, so the right of the investors to certain financial statements, an annual budget, access to management in some capacity, inspection rights to come in and inspect the company's offices or facilities. So we often see that negotiated in connection with a preferred stock round. Same with preemptive rights. These are your pro rata rights to participate in future rounds. So if you own 10% of the company, you have a right to purchase 10% of future equity or debt rounds of the company. Sometimes this is limited, same with information rights, to just certain quote unquote major investors that have put in a certain amount of money. Maybe it's 100,000, maybe it's 250. Sometimes it's open to all investors, just depends on the negotiation. We often, maybe not often, but sometimes we also see provisions that relate to the forfeiture of this right. So if an investor or major investor has this preemptive right, but doesn't exercise it in connection with a certain financing, then they lose that right going forward. Again, we don't see that all the time, but it is something that can be negotiated in connection with that. So those are the main, again, kitchen sink terms of a preferred stock financing. Some of those terms can be applicable and can be negotiated in connection with these convertible securities I'm going to talk about now. But those are kind of the ins and outs of preferred stock financing rounds. So the next two I'm going to talk about are your convertible securities bucket, right? So you have your price preferred stock round, and now we have a convertible security round. So why do a convertible security round as opposed to a preferred stock financing round? With a preferred stock financing round, you pay this amount of money, buying these shares at this price per share, and you get this percentage of the company. It's pretty straightforward. It's easy for folks to understand, and each investor knows what they have going forward. So why not do that? A couple of reasons. Two of the main ones are probably efficiency. As I talked about with some of the preferred stock documents, they can be long. They can take some time to negotiate. Convertible securities often have less documents, not necessarily, but often have less documents, have less terms, have shorter agreements, and therefore can be negotiated quicker and can, everybody can get to a closing much quicker. Valuation. So I mentioned that in order to do a preferred stock round, you need a valuation. And again, sometimes that's a hard thing to do. Again, because of the nature or the stage of a company, or the views of the company internally and the views of investors who are looking to invest in the company. So if you can't come to terms on a valuation, or maybe you don't want to, a convertible security allows you to kind of kick that can down the road a little bit and not have to set a valuation and let a future third-party investor set that valuation, and then you'll use that valuation to convert your convertible security. So convertible notes, what's a convertible note? So theoretically, it's a debt instrument, although you might have some courts argue with you on that. But theoretically, it's a debt instrument, like another, some other form of loan or promissory note in the company. As debt, it again theoretically sits above the stock of the company, the owners of the company. If the company, were to go under or liquidate, debt generally gets paid back first before the stockholders of the company. As debt, it has some typical debt features like a maturity date. So, there's typically a maturity date set that, if that date comes, the convertible notes have to be paid back. There's typically an interest rate, just like a normal promissory note or loan, and accrues on the principal amount of the convertible note, and generally gets paid back if the note gets paid back or gets converted along with the principal if the note gets converted. But typically, the point of a convertible note, and everybody involved, is aspiring to convert that note into stock of the company. The investors are not just looking to get their principal plus some interest back. Otherwise, they would have just done a normal, promissory note or loan. They're looking to share in the upside of the company, the growth of the company, the potential future value of the company. And to do that, they ultimately have to be stockholders of the company. So the hope, the aim is to convert that convertible note, that investment, plus any interest into stock of the company at some point in the future. And oftentimes, that's in connection with a future preferred stock financing round. So I have a couple things listed. These are some of the typical conversion triggers. You have your qualified or non-qualified financing. Qualified financing is generally just a preferred stock round that meets a certain threshold of proceeds to the company. So, if and when the company does a preferred stock round with proceeds to the company of at least $5 million, then the notes will automatically convert. Other conversion triggers could be a sale of the company. Sometimes there will be, hey, you get your money back on a sale, or you get 1.5 or 2 times your money back on a sale, or you might convert into securities of the company at an exit and share in the proceeds along with other stockholders of the company. Same with maturity. I mentioned, most of these convertible notes will have a maturity date. Oftentimes it's required to repay the principal plus interest on maturity, but other times you can negotiate that instead of repayment at maturity, the notes will convert into stock of the company at some sort of discount to a prior round or some sort of valuation cap. Conversion mechanics. So one of the theories behind convertible notes and safes, which we'll talk about in a minute, are, you're putting in money now, there's no valuation. Theoretically, the company is riskier than it will be when the next priced preferred stock round comes along. So we should get some sort of reward for putting in our money now. And that takes the form of either a conversion, or sometimes referred to as a valuation cap, or a discount. Sometimes there's both, but those are the two main conversion mechanics. So what are those? So a discount is pretty straightforward. If and when the company has its next preferred stock financing round, and let's say the investors there are purchasing their stock for $1 a share, you would get your stock, your principal and interest would convert into the same stock at some discounted rate. So maybe 10% or 20%. So instead of paying $1 a share, your convertible note would convert into shares at 90 cents a share or 80 cents a share. A conversion cap is another way to get a discount, and it's basically saying we're going to set the cap of valuation that we'll convert at. So maybe it's $7 million, and the new investors in the preferred stock round are coming in at $10 million. So you would convert, essentially at a 30% discount at a $7 million valuation instead of a $10 million valuation. and again, get more shares, get more bang for your buck than the new investors do. Other terms, convertible notes can be secured just like any other debt. So the note holders can hold a security interest on the assets of the company or a certain subset of the assets. Oftentimes prepayment is restricted. Again, most convertible note holders are doing a convertible note because they want to convert and they want to be able to share in the upside. So giving the company the ability to prepay kind of takes that away from them. So there's usually some restrictions on prepayment. Sometimes there's a most favored nations clause, basically saying, hey, if we're doing a convertible note round, you're giving us a 10% discount, but if before we convert, you do another convertible note round and you give other folks a 20% discount or a better cap or give them a security interest, and we didn't get one, well, we're going to get those terms too. And then, negative covenants, other rights, kind of, a lot of the rights we talked about with preferred stock, information rights, pro rata rights, right of first refusal, the negative covenants are kind of akin to your protective provisions, your vetoes. Those can be negotiated too. Again, you see less of those, generally speaking, in a convertible note round, but they still can be negotiated. Okay, so the other main type of convertible security we see is the simple agreement for future equity, or the SAFE. This was developed by Y Combinator, which is a coastal accelerator and early stage investor. And they basically came up with a form document, or it turns out to be several form documents based on the terms, but a form document that acts similar to convertible note, whereas the investors put their money in return get a SAFE document, and that SAFE document converts into stock of the company at some future event. But it's not debt like convertible notes. It's doesn't typically have a maturity date or any type of interest. So it's a little more slimmed down. It's a little more pro company. And because there are set forms that are up on the Y Combinator website, they're very efficient to negotiate. Again, convertible notes generally are easier and shorter to negotiate than maybe a full-blown preferred stock round, but there aren't set forms out there that have been developed by reputable organizations that anybody can turn to. Every law firm, maybe even every company, will have their own flavor of convertible note, but there's no one set term or one set form. So the beauty of the Y Combinator SAFE is there is a set form. It's out there. Everybody can access it, and everybody can use that as a starting point for their rounds. So super efficient. Again, like the convertible note, they convert at a cap that's negotiated or a discount. They can, a SAFE can include one or both or neither. They can often include a most favored nation. Again, if you do a future SAFE round while my SAFE is still outstanding, but you're giving those SAFE holders better terms, more investor-friendly terms, you'll give them to me as well. Pro rata rights, we sometimes see they used to be included in the standard form. Now it's kind of set off in a side letter, but that's another term we often see in SAFE rounds. The difference with SAFE rounds as opposed to convertible note rounds is you generally don't see a lot more than that. Maybe there's information rights, but you generally don't see a lot more than that negotiated into a SAFE round. Where convertible notes rounds, again, you can have some of the more preferred stock-like terms negotiated to those. So the SAFEs generally tend to be shorter, generally tend to be more efficient. In the past, they were used more on the coasts and used more for smaller financings, but over the last several years, we're seeing a lot more in our neck of the woods, and we're seeing it actually for larger and larger investment rounds, even the $50+ million rounds we've seen SAFEs used. So it's another tool that investors and companies can use to help finance the company, maybe in a way where valuation is still a little obscure or hard to agree to, or where we want a super efficient way to bring in money in a short period of time. So those are the two main types of startup financings we see. I mean, those are probably 90 to 95% of the financings we see is some flavor of a preferred stock or convertible security. We often see, or we sometimes see, and more often have seen in the last year or two, kind of your venture debt financing. More mature startups may have access to your traditional, bank or institutional lender financings, but your very early stage companies just don't have the credit history or the credit worthiness to get attractive terms from a traditional lender. So we've seen a number of kind of venture debt lenders kind of enter the arena, and a lot of our clients have gone after and successfully achieved or successfully negotiated venture debt rounds. Typically, debt is non-dilutive, so that's an advantage, right? You're not selling a stake in your company. Most venture debt rounds, though, will have some sort of warrant coverage, so you're giving, a small slice in return for access to the debt. But generally speaking, only certain companies are going to qualify. There's many details and hurdles that you'll need to jump in order to qualify for a loan, depending on the investor. And even when you do, those terms can be fairly expensive, can be fairly rich for a lot of startups. So many startups might just be priced out because the debt is too expensive. And unlike your preferred stock round, and generally speaking, your convertible notes and your safes, which don't need to be paid back, or maybe a convertible note does, but it's not until the maturity date. Debt, including venture debt, often needs to be repaid on a set schedule, sometimes starting almost right away, if not right away. So it can impact your cash flow and your balance sheet, depending on what that repayment schedule is, and again, what the interest rate is, which can be fairly rich for a startup. So that's kind of the third bucket of financings we see. Again, definitely see less of these, but some of the more mature startups we represent and interact with do take this route as maybe not even a way to bring in a large chunk of cash, but the ability to have access to that if needed. So a company might raise a large round, and then right after that, with kind of the buildup they've gotten from that, preferred stock or convertible note or safe round, use that as a way to leverage some venture debt. Again, not to put on their balance sheet, but to have access to it if they need it. Just a few other kind of points I wanted to make before we wrapped up here. Typically, outside of maybe a safe round, you're going to start with a term sheet for the main terms of the round. Is it a preferred stock round? If so, what's the valuation? What's the preference? Is there a dividend, et cetera, et cetera? Some other items that I haven't mentioned or that might be included on a term sheet would be, how much are you raising? Investors just don't want to give you carte blanche to go out and raise, unlimited amounts of money, because at the end of the day, that will dilute the investors. So typically there's an amount, hey, the company needs this much, we'll give you a little buffer, raise this much. Sometimes there's a minimum to close. You want to get a kind of a critical mass of investors to invest before, your lead investor or your lead group of investors will actually put their money in. So, hey, we're going out and we're going to raise 2 million, but nobody's going to close until you raise, you have, 750,000 ready to go. Because no investor wants to be that first domino to fall, and then it turns out nobody else is buying them. And then other closing conditions, Obviously, there's diligence that a lot of investors are doing to make sure, there's no issues from a contract or litigation or IP perspective. There also could be, other closing conditions, making sure there's D&O insurance in place, for example, or making sure, the founders' stock restriction agreements with respect to their vesting have been amended to include new vesting terms. So you often see that negotiated up front. Here are the terms of the round, but before we close, we want to see X, Y, and Z. So those are some other kind of term sheet items we see. And that's really all I had. Again, the three main buckets, the preferred stock equity round, the convertible securities, and the debt are generally, 98, 99% of the startup financings we see. If anyone has any questions, I'm more than happy to answer. I'm also happy to, take any questions offline if, anyone has something specific they want to discuss.
Yeah, thanks so much, Sean. Appreciate your time with the presentation. We do have a couple questions that have come in. For everyone who's still on the call, we will be sharing, like I said, a recording of this after, and we'll include Sean's contact information as well. So if you have any questions, feel free to, you can access his email and feel free to reach out to him directly. So the first question we have is, can you discuss how common participating is compared to non-participating?
Yeah, great question. So there's definitely been a trend towards more non-participating rounds. Obviously, participating preferred stock is more investor friendly. It's pro-investor and at the detriment of the founders. But on the coast, they realized this, a lot earlier than our neck of the woods, that you need to keep your founders incentivized. And depending on the number of equity financings you do, the preference stacks of each of those rounds can start to add up. And if the founders are underneath all those preference stacks, especially when it's preferred or participating preferred, where it just compounds that stack, their incentive can become less and less and less. So in order to kind of keep up and maintain that incentive level for the founders and for the service providers of the company who typically hold the common stock, they've seen non-participating, even though it's more pro-company, to be actually favorable. So, when I started out at Thompson Hine 5 years ago working with our companies, I think I saw probably more participating preferred stock rounds than non-participating, but that's flipped in the last 5 years. And I think we're seeing a lot more non-participating and less participating.
Great. And then another question, which of these are usually registered securities?
Well, so registered securities basically means that your stock is publicly sold. So you're a public company. So in order to be a public company, you have to have stock that's listed on some exchange, or your stock has to be registered. So if you're going to be a public company, you'll have stock, and any convertible notes or safes will have been converted into stock prior to that IPO. In selling any type of security, whether it's preferred stock or convertible notes or safes, you have to make sure that there's a valid exemption for registering that security with the SEC. So generally speaking, unless there's an exemption or exception, securities have to be registered, have to be publicly sold. So you have to make sure that there is a valid exemption, and there's plenty of exemptions out there based on the nature of your round, but kind of avoiding having to register your securities before you're ready to go public, which requires millions of dollars and expenses and fees and different reporting requirements. You want to make sure that you fall in one of those exemptions before you sell those securities.
Great, thank you. So as of right now, those are the questions we've gotten through the chat. If anyone else, oh, sorry, spoke too soon. We have one more. Before I jump to this question, we have gotten a couple requests to share this slide deck. So just so everyone knows, I'll confirm with Sean, make sure there's nothing in his deck that's proprietary or confidential. And if he's good with it, we'll plan to share the deck along with the recording as well as his contact information.
Yep,
Okay,
sounds great.
perfect. So next question. Investing in these highly early stage ventures is highly risky. So how do you see investors justifying safes, providing a reasonable return for that risk when compared either to stock or notes?
Yeah, so again, I mean, safes are fairly similar to notes, although they don't have, the maturity date or the interest rate, but they provide similar incentives to investors like convertible notes, where you may be kicking the can down the road on valuation, but when that price equity round comes, you're going to get some sort of discount. So you're going to get more bang for your buck, and that's the incentive for those types of rounds from the investor side. From the company side, it's more efficient. You can get it in theoretically quicker. You can get around funded and closed quicker. But from an investor side, you end up with that discount, or using the cap, sometimes a significant discount, which compensates, for lack of a better word, the investors for the risk they are taking by making kind of an earlier stage investment.
Perfect, thanks. And then next question, any comment on LLC versus S or C Corp?
Yeah, no, that's a great question. So our firm recommendation, if a new client comes to us and says we want to form a company, we want to form a startup, is to go with a Delaware C Corp. There's a lot of reasons for that, but I mean, generally speaking, most sophisticated startup investors, including most institutional investors or venture capital firms, want to invest in Delaware C Corps. S Corps are great for smaller businesses, but only certain kinds of investors can be stockholders in an S Corp. It generally limits to certain individuals and maybe certain forms of trust, but generally speaking, a VC isn't going to be able to invest in an S corporation. Likewise, LLCs have some kind of tax and administrative hurdles that can be detrimental to not only the company, but also to institutional and VC investors. So for those reasons, along with the fact that Delaware corporate law is the most robust, it's generally seen as kind of the gold standard for corporate law, and their kind of case law is just as robust, if not more so, than other states. Generally, Delaware C Corp is the way to go.
Thank you. Sean, what are you seeing generally about valuations, discounts on notes, et cetera, locally compared to the coasts?
Yeah, that's a good question. I mean, historically on the coasts, valuations are higher and discounts are lower. So generally speaking, more pro company kind of across the board. And there's a number of reasons for that, but there's often, for any given deal, a lot more capital and a lot more investors vying for that investment in some of these areas and the coast. So generally speaking, we do see higher valuations, sometimes significantly higher valuations than we would expect if the company was doing a local round. And same with some of the other terms, getting better company, more pro company terms on the coast as opposed to around here. And that kind of goes back to my comment on participating versus non-participating. The coast kind of led the charge on the non-participating. And here in the Midwest, that tide has turned, but it definitely took longer than it did on the coast. So that, from that perspective, that turned more pro company quicker than it has around here.
Thank you. Are you seeing much activity with Title III investments in startups?
Some, but not, I would say not a ton. After this last year, with the PPP and EIDL loans, those were kind of the newest wave of investments that we saw. Now we're on the tail end of folks applying for forgiveness of those, but those kind of where there might have been a pause on some other types of investment, including the traditional investments that we talked about today. And there's more of the PPP stuff that has kind of come and gone, along with some of the other pandemic items. And now we're kind of seeing more traditional startup investments.
Great. Those are the questions that we had in the chat. So Sean, thank you so much for taking the time out of your busy schedule to be with us this afternoon and present on this, really relevant and informative topic with this group. Attendees, as I mentioned, will be sharing the recording, the slide deck, as well as Sean's contact information, all via email this afternoon. So if you have any questions or want to talk specifics as they relate to your individual business or organization, please feel free to reach out to him directly. And thank you all so much for being here, and look forward to seeing you at another event here soon. Thanks so much, everyone.